What if I told you that you can buy real estate, businesses, startups, collectibles, franchises, or even local businesses as small as $10 to $1,000? And you can do it without having to actually go through and do all of the work of actually owning it. This is called fractional investing. And in this video, I'm going to show you how, the 5 ways that you can invest in these different types of assets. Now, first, we actually live in a golden era of investing, opportunities that no generation has ever had before previously. Most just don't know about it. You have to remember that prior to the last 15 years, to invest into a business, to get a startup, or even collectibles or anything like that, it was the who's who. It's about who you know, the opportunities. This was all about the country club and getting into a direct investment. The world is broken up into 2 sections, and this describes the wealth gap in its entirety. Those that actually own the economy and those that don't. That's it. The wealth gap is simply an ownership gap, nothing else. In fact, the world is so divided by this, it's almost unrecognizable, meaning that tax law, investment structures, returns, everything else is totally different. They're operating on a different system, a system that I have used for over 20 years to make me wealthy. But in order to access that system, it used to be very difficult. It used to require a lot of money, and it required you to have the connections, the know-how, and really to be given that opportunity, or go the hard way and create it from scratch. It was simply for the wealthy to get more wealthy. But the internet revolutionized a lot of things. And over the last 10 years, it has revolutionized investing. I am a big believer in democratizing ownership. I am a big believer in capitalism, but that it only works if the people participate and can participate. When you get into a system where only a few can participate and get all the gains, it doesn't work. The first round of the internet world had the opposite effect of democratizing. It consolidated. It consolidated companies, assets, opportunities, and growth into the hands of a few. We see the effects of that today, and most people are still using the playbook of the baby boomers to get wealthy. That playbook doesn't work, which is how it always happens. The way that one generation made their money is by creating a new system. The next generation creates a new system, and then they become wealthy. So what worked for the baby boomers didn't work for their parents. Trying to use a system that worked in the 80s makes no sense at all. The method is still the same. That hasn't changed. How you get there and go about it is what has. Now, before I break down into each one of these segments, and before I talk about the companies that actually do this and how to do it, I need to put a disclaimer. I am not affiliated with these companies. I don't use all of these companies. Some I have. I do not back them, verify anything for them. I am simply showing you this world and how to access it. It is up to you to do all the research, make your own decisions. I am also going to show you the pros and cons and what you need to know. With that, let's get started. Fractional ownership. What is it? Fractional ownership is a simple idea. It is what the stock market is based on. You have a company, they take their ownership, they allow the public to buy parts of their ownership. If you buy a stock, you have and are participating in fractional ownership. But that represents actually not a huge portion of the economy. The world of alternative assets is where wealthy move their money. It's what they buy, When you look at the GDP and the growth of wealth of nations, the stock market isn't a representation of the whole GDP or all that growth. In fact, sometimes it's actually a poor representative of it. The vast majority of wealthy did not get wealthy through the stock market. Now, the ones you know about or hear on TV do. The reason why is because, first of all, they're astronomically wealthy. If you start a company that gets on the Dow or the NASDAQ, it's going to be really, really big. Also, it's total public information. So everybody can see and everybody knows. But 99% of the wealthy people in the United States and the world did not get wealthy through this method, and you don't know about them. But they, like others, use fractional ownership. This is how I became wealthy. This is also how I built a company that has hundreds of millions in assets. But even the way that I did it was still predicated on an older model and is harder to do and hard to break into. Why? Because of laws. You have accredited investors and non-accredited investors. These laws dictate who can have access to what. And non-accredited investors, meaning you do not have $1 million worth of value, excluding your home, to invest, or you do not make over $300,000 as an individual, they don't have access. So all those opportunities are only allowed by the government to go to rich people. This is where the opportunity comes in. Almost all of this has only been around since 2016, when the United States laws changed. And because of technology, we actually had a means to deliver fractional ownership into the hands of everyone. And most importantly, direct investments, real assets. You really own them. We're not talking about a stock, which you get no tax benefits really from. It just goes up and down. It's not a public market. I'm talking about the private markets, the markets that the wealthy build, play in, and make all their money in. So let's start with the first one. This one is an easier one, real estate. With $10 to $100, you can immediately invest and buy small shares of actual real estate. Yes, I mean homes, but also things like commercial real estate, where you're actually the owner. You get the benefits from it, like tax benefits. You get the equity, as well as the distribution of the cash flows. You get exposure and can own a small piece without having to buy the entire property. You don't have to manage it or run it. You receive the proportional rent, appreciation, and with some of these and lots of them, also the tax benefits. I'm starting out with this because I'm intimately familiar with this, seeing how I have a company that offers fractional ownership to accredited investors. Once again, it's behind that line. The owners actually come in alongside me and own with me and my money parts of the real estate. We do self-storage. Now, there's all sorts of different real estate assets, but me and other companies generally have large minimums, like 50,000 at the low end, 100,000+ to even participate. So the vast majority of people can't. They don't even get that opportunity. But there are companies like Lofty, Fundrise. You have companies like K7 and others that allow you to go in, look, see the properties, actually look at the financials, their locations, everything else associated with that property, and invest small amounts of money to own parts of those properties. This is called actual crowdfunding to startups. Now, a lot of people may have heard of this. You have things like WeFunder, Start Engine, or Republic. These offer you to become an owner in early stage companies and participate in that equity. Now, these are obviously more risky assets. You are investing in startups. Lots of times they're not even cash flow positive, but you become an actual shareholder in the early stages of this company. Using a crowdfunding platform, it's the same thing. You sign up, you get to choose, look, and invest. Now, with something like this, the trade-offs are high risk, but potentially high return. You have long-term horizons. And you also need to do your due diligence. That's the thing with direct investing. They're not ETFs, and they're not just publicly accessible shares. But that's also why direct investing gives you those opportunities, those returns, those tax benefits. But you need to look and do your own due diligence on those companies. But this also allows you to look and invest in things that you like or believe in. See who's doing it, running it, the founders, what the mission is, things that you understand. Number 3, small businesses that are being owned and operated. We're talking about $50 to $500, being able to log in, do your due diligence, and choose. Now, these can be much more of a predictable yield and earnings and have track records, but they're still small companies. The companies that allow you to do this are companies like Kiva, Mainvest, or even Honeycomb Credit that allows you to invest in local businesses and get more of a fractional share of ownership or debt yields, meaning you can invest in small local businesses. Now, once again, I need to reiterate, I have no affiliation with these companies. They're not paying me to use their name. I don't know them. I have nothing to do with them. I am not sponsoring them, backing them, or telling you to go to them. Now, on to number 4. This one is exciting, and I didn't even know that this was around. Of course, we know that wealthy invest in lots of different things. We're talking about fine art, music royalty, equipment financing, wine or sports cards. Platforms like Rally, Masterworks, or Royal, they all offer this ability. Now, these are true alternative assets. Now, these lots of times are opaque markets which are done behind the scenes. People don't even see or know them. I obviously didn't go to my local Walmart to pick up Ernie, who, yes, is real. This is probably one of the more exclusive markets of the wealthy that is now being offered fractionally and more open to the public. A lot of these things are some of the best performing assets that just don't lose their value. Now, you really need to understand the difference between equity, cash flow, value, and how you get your return on your money with each of these different platforms. Some are storing a value, some are cash flow plus equity plays, others are more debt and yield plays where you're getting consistent returns. They're all different. And then there's number 5, something that I have done and I love, especially for younger people, digital assets. You can buy and own digital assets that are cash flowing, like buying a digital vending machine. I'm not talking about buying a course, I'm talking about the actual vending machine. Or cash flowing online stores that are vetted and there's operators in place. Micro franchise kits like cleaning, detailing cars, or even pet services. Out of these, we have micro franchising and digital assets. Now, the digital assets I like because you can buy the whole thing if you want, meaning you can go buy a website that is simply delivering ads. Now, it may make $200 a month, but you can buy it at a really low cost. It's transferred over to you, you own all of it, and it makes cash flowing $200 a month consistently. You can even look at the history of it. The companies that actually put these on, they help vet. Look at all the financials and brokerage out for you to buy these very small assets. Companies like Empire Flippers, Flippa, and Niche Investors, which allow you to buy very niche blogs. There's all sorts of digital assets that are cash flowing, and you can even grow. That's what I like about it. I can buy something for a small amount that's cash flowing, but also with very little work at all, which I can hire a VA to do. I can improve and increase that cash flow. That side, the digital asset, is a little different than fractional ownership because you're actually buying the thing. But I include it in this because of the small amount that it takes to get started. So, crowdfunding startups, it's fast, $10 to $100, and you get that startup equity. You have local business investing. maybe as little as $50. Also, very quick for you to do. A revenue share and even loan models that give you yield. Collectibles, fast, as easy as $10, and you get alt asset shares. Microfinancing. Now, that's not quite as fast. It takes a little more work, but still, it's quick. $200 to $1,000. Small business, cash flows. Digital assets, where you actually own your own small little income producing business. Now, it's important for you to understand that these options didn't exist just over 10 years ago. We are in a golden era of normal, everyday working people being able to participate in assets that aren't the stock market. You can think of yourself like your own personal venture capitalist fund that you have. Or maybe you want to be a real estate investor, even though you don't have a lot of money. Or private equity, where you're buying bonds, franchises, cash flowing small businesses. Remember, you have what is called retail investors, and they only get public markets, and most of the time, all the yield's already been taken out. Now, the positive side about public markets is you just buy shares, index funds. They're very low risk, and over time, they generally do well. But that doesn't offer you leverage, experience, cash flow, or any of the other things like tax advantages. There are so many opportunities today for you to actually participate in the economy, to own it. The line between those that own the economy and consolidate all the assets and wealth to those that don't have the opportunity is shifting. That is a great thing and something I'm very passionate about. Now, you need to be skeptical. You need to do due diligence. This is not the stock market. A lot of these are not liquid assets, meaning you don't get to put it in and then just 6 months later take your money out. It's not like that. Now, some are, but not all of them. They're very, very different. You need to understand what you're trying to achieve, what works best for you, create a plan, and do due diligence. Here are the things that you need to look for. First of all, fees and hold period. Some opportunities may be drowned out in fees and may have very long hold periods where maybe the exit isn't even clear. Maybe the sponsor is getting their money and you're not, and you have to wait for an eventual event to happen. I always look for sponsor and investor alignment. With my company, for example, we're offering a fund of assets. I'm the largest investor in that fund, and we also don't take a split or anything else until the investors are all paid back. That's not how all of these work. And you need to make sure that there's alignment. The next thing you need to look for is not all offerings are created equal. Risk and reward vary wildly depending on the assets and all these different options that I've been talking about. Now, you also need to be looking at track record and scale. Some of these platforms are newer and just come out, while others have a long track record, like Empire Flippers. And the last thing you need to make sure you understand in the offerings is what is real ownership versus not. Look at how the structure is actually set up. One of the things that I like most about this is you can actually go through and do these things so you can learn without having to put in tens of thousands or hundreds of thousands of dollars that you probably don't even have, or you have to risk it all. This gives you the ability to start small, learn, figure out how you do due diligence, what you need to know and understand, what works and what doesn't, and you can build from there. That is a learning experience that you can't get anywhere actually doing. My goal here is to help others break into the real economy, to actually own and benefit when the economy grows, that they're not left behind. This is what I teach, how to break into this world. We analyze business, assets, we talk about the economy. Learning is the biggest opportunity. It is what separates those that are doing from those that are not. They have knowledge, and knowledge creates opportunities. So make sure you're subscribed, like, and comment below what assets and businesses you're looking into.